morning. So in this video, let us discuss more about accounting concepts, conventions and standards, and exclusively accounting concepts. So we have seen what is GAAP. GAAP means generally accepted accounting principles. That means established rules which we have to keep in mind while preparing various accounting transactions. So in this we can discuss what are accounting concepts. So accounting concepts means necessary conditions or informations or systems which we have to keep in mind while recording the transactions. So there are various concepts related to accounting, how we should see through or how we should record each of the activities or the accounting transactions are based on these concepts. So these are the few accounting concepts. First one is business entity concept, or we can say accounting entity concept. Okay. So what is business entity concept? Business entity concept says that business is separate from its owner. So probably a business will be started by sometimes one person, sometimes a group of people. So whatever it be, always the business and its transactions should be always kept separately. It should not be clubbed with the person or the person handling it or the owner of the business. Should the owner put some amount into the business, that is known as capital. So even that is actually a liability of the business. That is why we consider the capital invested by the owner as the liability of the business. The business have to repay the owner that amount. So that is what is business entity concept. Always the transactions of the business have to be kept separate from its owner. That is business entity concept. No transactions should be clubbed with the owner's personal things. So that is business entity concept, or it is also known as accounting entity concept. Second one is money measurement concept. So what is money measurement concept means? In accounting, usually we record the transactions that are basically related to money, or those transactions which we can value in terms of money. And also the other things or the transactions which we cannot measure in value are ignored, or are not being recorded properly. So that is money measurement concept. Money measurement concept means we record those transactions which are related or which are in terms of money. So the transactions like or the thing like quality or like that which we cannot measure in terms of money, we are not recorded as it is. Another concept is going concern concept. What is going concern concept? Going concern means we are assuming that our business entity is continued for a particular time or for a particular period. So the business and its processes are being carried out indefinitely. So it is a never-ending process. So that is the concept of going concern. Our business will not be stopped, or we assume that it will not be stopped the next day or the next month. It is going in a continuous basis. That is what is going concern concept. So the records or the transactions which we record are recorded based on the idea that our business is a going concern entity. Okay. Another concept is accounting period concept. Accounting period concept says that though we assume that our business is a going concern, that means which will not stop in the near future, we have to split the period. That means we have in order to account properly, or in order to calculate the various values, we must we must have to divide this going concern entity into separate periods. That is what is accounting period concept says. That means we have to split the period accordingly. It can be either an year or half an year or like that. According to our convenience, we can divide the going concern entity into different periods in order to ascertain or to find out the profit, loss and the position of the business. That is what is accounting period concept. There we divide the accounting concern or the going concern entity. We divide either in a yearly basis or half yearly basis or quarterly, and whatever be the basis, in order to find out the profit or loss for that particular period. Another concept is cost concept. Cost concept says that we value everything, or we value the assets based on its actual cost or based on its purchase cost or initial cost. So all the transactions according to this cost concept are recorded in its actual or original cost. Another concept is dual aspect concept. So dual aspect concept means for the various transactions we record in the accounts, there is two aspects. For every transaction there are two aspects, one receiving aspect as well as one giving aspect. That means, for example, any transaction, one example, a cash sale. We make a cash sale in our company, then we make sales and we get amount. So the receiving aspect is money and the giving aspect is sale or our goods. So there are two aspects related to that transaction. So that is dual aspect concept. According to dual aspect concept, there are two aspects, a receiving aspect as well as a giving aspect for our each transaction. Next concept is matching concept. Matching concept implies that all the revenues of a particular area are matched with the expense of that particular area. Because for example, we produce goods and we sell goods. So there are many expenses related to the production. Similarly, we get incomes in the way of sales or any other income. So every time this matching concept means these expenses of a particular period are related or matched with the income of that particular period. Then only we can ascertain the correct profit or loss for that particular period. That means if we incur few expenses and for these expense we get an income, we can easily know the revenue, whether it is profit or loss. So that is why matching concept is taught. All the expenses of a particular period have to be matched with the income of that particular period. So that is matching concept. Next is accrual concept. What is accrual? Accrual concept means here we record transactions as and when it happen. That means sometimes some transactions may occur, but the money may be received or the amount or the income may be received later. Similarly, sometimes expenses may be incurred now but may be given later. So under accrual concept, we record transactions as and when it happens or it occurs. So not actual movement of cash is being took into consideration under accrual concept. Under accrual concept, we record transactions as and when it happens. Next is a realization concept. Under realization concept, we record transactions according to the revenue we recognize. As and when we recognize the revenue, we record the transactions. And last one is Objectivity Concept. Objectivity Concept means all the transactions which we record in our books have to be supported by a material evidence. Every transaction which we record anywhere in our books of accounts have to be it must have an adequate supporting evidence. Then only we can verify the transaction for any error. So objectivity concept means all the transaction must have a supportive evidence or supporting document in order to verify the transaction later. So these are the main accounting concepts. We have to follow all these concepts in our mind while preparing different accounting or while recording different accounting transactions. So accounting concepts means the general rules which we have to keep in mind while recording the transactions. The main accounting concepts are business entity concept, where business is separate and owner is separate. So the accounts of the business should not be clubbed with the accounts of the owner. Second is money measurement. All transactions which can be recorded in terms of money are only recorded. Going concern concept means in it we consider our entity as a going concern which continue for an indefinite period. Accounting period concept. In that concept, we divide the going concern entity into different periods for ascertaining the profit or loss of those particular periods. Then cost concept, we measure or we record the informations or amount in its original cost. Dual aspect means every aspect or every transaction have a debit aspect and a credit aspect, or a receiving aspect and a giving aspect. Then matching concept means the expenses and revenue of a particular period have to be matched proportionately or appropriately in order to find out the profit of or loss of that particular period. Next is accrual concept. Accrual concept means here we record the transaction as and when it happened without waiting for the actual receipt or payment of the amount. Realization concept, we recognize or we record the transaction as and when the revenue is realized. Then objectivity concept means all the transactions which we record must have a supporting material evidence. So hope you are clear with the various accounting concepts. Now let us discuss which are the various accounting conventions. So we have already discussed which are the accounting concepts. Accounting concepts means the necessary conditions which we have to follow while recording the transactions. Accounting conventions means the customs or traditions which we have been following while preparing the various accounting transactions or while finding out the profit loss of the business. So which are the various accounting conventions being followed? First one is consistency convention. Consistency convention means, or convention of consistency means, we have to according to this it is told that we have to follow a particular mode of accounting or a particular method of accounting for a fixed period of time or for a particular period of time. That means there are various techniques or various methods, different types of accounting techniques, methods, procedures, rules, etc. So consistency concept tell that if we follow a particular type of method for a year, we can follow it for continuously. But that means there should be a consistency in following. We should not shift in between or we should not shift very often. That is consistency concept. That means, for example, there is a concept called depreciation. Depreciation means the decreasing in the value of fixed assets. So, in order to find out depreciation, there are various methods like straight line method, diminishing balance method, sinking fund method. There are different methods. So if we are following straight line method in a year, it is better to follow that method for another 2 or 3 years. That means we should not shift very often to another method. That is what is convention of consistency. We have to follow or try to be consistent while doing different accounting or while adopting different accounting methods. But that never mean that we should not at all shift to another method. We can shift to another method if it is adequate or if it is needed. We can shift. But convention tell that it is better to follow a particular accounting method for a particular period of time. That is convention of consistency. Second one is convention of materiality. So, convention of materiality tell that only material items have to be recorded in books of accounts. There will be many things happening in our business. So we need not record each and every minute things in the accounts. But this materiality concept, or what is material? Material means important. So what is material for an organization may not be the one which is material for another organization. So it differs or it depends on organization to organization on what items are material for them. So materiality concept says that only material items have to be recorded or have to be ascertained or calculated, and other items we can ignore. Then next is convention of conservatism. So convention of conservatism is also known as doctrine of prudence. Doctrine of prudence. So what does this mean is that according to the conservatism concept, we anticipate for all possible losses which may occur in the future, but we never anticipate or we never keep aside or for anything or any income which we may receive in the future. So that is the doctrine of prudence. That means we anticipate or we keep aside or we keep as a provision for future unanticipated losses, but we never record or never anticipate any incomes in the future. That is the convention of conservatism. It is also known as doctrine of prudence, because if unexpected any contingencies or any emergency situations occur, it will be useful. The provisions or those we have kept for future unanticipated losses, we can use it and we can solve the situation. So that is the convention of conservatism. And last one is full disclosure concept. Full disclosure concept tell that while recording a transaction, we should not record a part of it or a few of it completely, or we have to record the transaction along with its particular verifying documents, or what are the documents available. So while recording a transaction, we have to keep all the things, all the documents related with that transaction in order to have a verification in the future. So that is full disclosure concept, or we have to record each and every item fully. So these are the basic accounting conventions. One is consistency. That means we can follow one accounting method for a particular period of time. Materiality concept, it means only material things have to be recorded. Conservatism concept, we anticipate for all possible losses but not for any incomes. And full disclosure concept, we have to disclose the items fully, or we should have amped evidence for all the items which we have recorded. Okay.